Warren Buffett has long been a voice of reason in the world of finance, and his recent comments on the automobile sector feel particularly prescient amid the turmoil gripping the U.S. auto industry. Buffett's philosophy isn't just about cars. It's a metaphor for deeper economic imbalances that are rippling across the broader market. With the Trump administration's aggressive push for what they've dubbed the Great Reset, a radical overhaul of trade policies unseen in over a century, Buffett's warnings ring true. Dealership lots are overflowing with brand-new vehicles that no one seems eager to buy, raising critical questions about the long-term ramifications of these policies on the economy as a whole. Where will this path lead us? To grasp Buffett's perspective, consider a personal anecdote that reveals much about his mindset. For over a decade, the billionaire drove a modest 2014 Cadillac XTS, eschewing flashy upgrades or the latest electric models in favor of reliability and frugality. His often quipped that time is too valuable to squander on constant car swaps. While some might dismiss this as eccentric billionaire behavior, it embodies a profound truth about value investing in consumer habits. In today's economy, marked by inflated prices, soaring interest rates, and geopolitical tensions disrupting supply chains and eroding consumer confidence, Americans are increasingly adopting a similar mindset. Big-ticket items like cars are being deferred, leading to a massive buildup of unsold inventory on dealer lots. Current estimates as of November 2025 paint a stark picture. Over 2.5 million new vehicles are languishing nationwide, a colossal accumulation of steel, rubber, and electronics depreciating under the sun. This isn't mere overproduction. It's a collision of excess supply and waning demand, creating ripple effects for manufacturers, dealers, and the wider economy. Yet, amid the gloom, there's a counterintuitive silver lining. Trump's tariff regime, while causing immediate supply chain upheavals, is paradoxically spurring a revival in domestic manufacturing. Foreign automakers are rushing to expand U.S. operations, constructing new plants, hiring local workers, and pouring billions into infrastructure to evade those tariffs. Even as unions navigate layoffs and contract uncertainties, their backing of Trump signals optimism for repatriated jobs and long-term gains over short-term hardships. Visualize the scene on these dealership lots, rows upon rows of pristine, zero-mile vehicles fresh from the factory, gathering dust. This imagery captures an industry reeling from post-pandemic whiplash. Recall 2020 to 2021, when COVID-19 lockdowns devastated semiconductor production, leaving millions of vehicles incomplete on assembly lines. Dealers faced empty lots, and buyers paid premium for used cars due to scarcity. By 2023, as supply chains normalize, production surged to compensate for lost time, with manufacturers anticipating sustained pent-up demand. But demand faltered. What worked in a desperate 2021 market, where buyers tolerated high prices, no longer holds. Consumer psychology shifted, and financial realities evolved dramatically. High financing costs have sidelined middle-class buyers. With average auto loan rates at around 7.5% in late 2025, financing a $50,000 vehicle over 5 or 6 years translates to monthly payments of $800 to $1,000, burdensome amid rising rent, groceries, childcare, and healthcare costs. Vehicle prices themselves have skyrocketed, with the average new car sticker exceeding $48,000, a 30% jump from a decade ago. Wages haven't matched this rise, and inflation has eroded purchasing power. Basic economics dictates that simultaneous hikes in prices and borrowing costs suppress demand. Manufacturers, expecting robust sales, overproduced, resulting in piled-up inventory. This glut poses its own dilemmas. Dealers rely on floor plan financing to stock lots, incurring daily interest while vehicles depreciate. A 2025 model in January 2026 is worth less than in November 2025, simply due to time. Dealers are squeezed, capital locked, interest accruing, asset values eroding. Unsustainable, this scenario demands adjustments, price cuts, cheaper financing, or reduced production, likely a mix. Trump's tariffs on imported vehicles in part exacerbate, but also reshape this dynamic. By making overseas production costlier, they aim to bolster domestic competitiveness. Short-term, they disrupted optimized global supply chains, raising costs past a consumers already strained by affordability issues. Yet, The long-term vision is rebuilding U.S. manufacturing resilience, reducing dependence on volatile international sources. Foreign players like Toyota, Honda, BMW, and Mercedes are responding with major U.S. investments, new southern plants, expansions, thousands of hires. This shift promises dividend for decades, fostering self-reliant supply chains. Unions recognize this, supporting Trump despite immediate pains, viewing it as a pathway to revitalize domestic jobs. Buffett's car philosophy, prioritize lasting value over fleeting upgrades, mirrors this. He sees an industry detached from fundamentals, unaffordable prices, debt-heavy financing, mismatched production and demand. The 2.5 million unsold cars symbolize an economy in reset mode. What emerges post-adjustment? That's the looming question. Electric vehicles, EVs, add layers to this pileup. Hailed as a future, EVs have flooded markets via Inflation Reduction Act subsidies, spurring models like Ford's F-150 Lightning and Chevy's Silverado EV. On paper, subsidies boosted production and affordability. In reality, consumer reluctance, overcharging infrastructure, range anxiety, towing cold weather limitations, has triggered discounting wars. Tesla, the EV pioneer, saw a 5% U.S. delivery drop in Q3 2025, prompting deep price cuts that squeezed sector-wide margins. Ford, GM, Mercedes, and BMW followed, eroding profitability. Buffett's depreciation warnings resonate. A $40,000 purchase drops to $25,000 upon driving off, a poor investment. He advocates cash buys, a radical notion in credit easer times, but it exposes financing's illusion of affordability. Buffett's Berkshire Hathaway ties to auto sectors, stakes in Copart, dealer networks, insurers, inform his caution. Recent divestments signal wariness of downturns. Yet, he notes resolved bottlenecks like semiconductor fixes as short-term hiccups in a rescuing arc. At core, Trump's America First trade wars intensify supply chain fractures. Post-2025 inauguration, 25% tariffs on imports invoke Section 232 for national security, arguing domestic manufacturing is vital. While no embargo on Volkswagen here, EU barriers to U.S. cars persist, justifying reciprocity. This corrects imbalances, but short-term fallout is harsh. GM directed suppliers to cut Chinese ties by 2027 or lose contracts. China dominates 40% of auto electronics and EV magnets. Alternatives are costly, spiking component prices 15 to 20%. Production halts in Michigan, Ohio ensued. A Quebec aluminum fire in September 2025 disrupted supplies. Tariffs barred cheap imports, idling Ford's F-150 and Jeep lines. Semiconductor shortages furloughed 1,200 at Stellantis. Inflation upped raw materials 12% year-over-year. Tariff uncertainty stalls investments. Erratic output floods lots amid stagnant wages and 4.5% unemployment. Affordability gaps persist, creating unsustainable cycles. The U.S. auto industry's current woes trace back to the chaotic aftermath of the COVID-19 pandemic, a period of extreme disruption that set the stage for today's inventory glut. In 2020 and 2021, global lockdowns crippled semiconductor manufacturing, those essential chips powering everything from engines to infotainment systems. Assembly lines ground to a halt, with millions of vehicles left incomplete, awaiting parts that simply weren't available. Dealerships stared at barren lots, and desperate buyers turned to the used market, often paying well above sticker prices for whatever they could find. It was a seller's paradise born of scarcity. Fast forward to 2023, supply chains began to mend, semiconductor flows resumed, and factories roared back to life. Manufacturers, eager to recoup lost ground, ramped up production aggressively, banking on persistent pent-up demand. But the market had evolved. The desperation of 2021 faded as economic realities shifted. High interest rates, persistent inflation, and stagnant wages combined to make new vehicles increasingly unattainable for average Americans. What once seemed like a temporary bottleneck has morphed into a structural mismatch between supply and demand. Consider the numbers. Average new vehicle prices have surpassed $48,000, a staggering 30% increase over the past decade. This isn't for luxury models but everyday sedans and SUVs. Meanwhile, Wages for most workers haven't kept pace, and inflation has gnawed at purchasing power. Layer on financing costs, auto loan rates lingering at 7.5%, and the math becomes prohibitive. A $50,000 loan over 5 years could mean $800 to $1,000 monthly payments, a hefty burden when household budgets are already stretched by higher costs for housing, food, and essentials. This affordability crisis is Economics 101 in action. When prices and borrowing expenses rise in tandem, demand inevitably contracts. Manufacturers, having overproduced in anticipation of strong sales, now face overflowing inventories. Dealers, caught in the middle, bear the brunt. Through floor plan financing, they borrow to acquire stock, paying interest daily while vehicles sit unsold. Depreciation kicks in immediately. A new model's value drops simply with a turn of the calendar, regardless of mileage. This erodes dealer margins and ties up capital, creating a pressure cooker that demands relief, whether through price reductions, easier credit, or production cuts. Trump's trade policies add fuel to this fire. By imposing 25% tariffs on imported vehicles and components, the administration seeks to protect domestic producers under the banner of national security via Section 232 of the Trade Expansion Act. The logic: a robust U.S. manufacturing base reduces vulnerability to foreign disruptions. Short-term, however, these measures have upended global supply chains optimized for cost efficiency. Parts once sourced cheaply from Mexico, Canada, or Asia now face duties, forcing reconfiguration. Costs rise, and manufacturers either absorb them, hurting profits, or pass them to consumers, worsening affordability woes. Yet, the policy's architects argue for long-term benefits. By making imports pricier, tariffs incentivize domestic production. Foreign automakers, keen to avoid penalties, are investing heavily in U.S. facilities. Toyota, Honda, BMW, and Mercedes are expanding plants in states like Ohio, Alabama, and South Carolina, creating thousands of jobs and bolstering local economies. This reshoring could foster resilient supply chains, less prone to global shocks, paying off over decades. Unions, despite grappling with immediate layoffs and plant idles, largely endorse this vision. The United Auto Workers, UAW, views tariffs as a corrective to decades of offshoring under agreements like NAFTA. Their support for Trump reflect belief in repatriated jobs, even amid short-term pain. As UAW President Shawn Fain put it in an NPR interview, these targeted tariffs bring jobs home. It's a nuanced stance, not blanket protectionism, but strategic measures for the auto sector. Buffett's philosophy ties this together. His aversion to frequent upgrades and emphasis on frugality highlight an industry divorced from value. Unsold cars symbolize supply-demand disconnects, prices untethered from reality. As the economy resets, the auto sector's adjustment could foreshadow broader market corrections. Electric vehicles, intended as the industry's salvation, are instead amplifying the pileup. Subsidies from the Inflation Reduction Act spurred a flood of EV models, like Ford's F-150 Lightning and GM's Silverado EV, making production and purchases more viable on paper. But consumer adoption lags due to infrastructure gaps, range concerns, and performance issues in towing or cold weather. This hesitation sparked a discounting frenzy. Tesla's 5% delivery dip in Q3 2025 led to aggressive price cuts, pressuring rivals like Ford and GM to follow. Margins across the EV space have suffered, turning what was a growth narrative into a profitability challenge. Buffett's warnings on depreciation and financing resonate here. He decries how a $40,000 vehicle loses $15,000 in value instantly upon purchase, labeling it a poor investment. His cash-only advice, while impractical for most, underscores financing's pitfalls, masking unaffordability in monthly payments that strain budgets over years. Berkshire's auto involvements in auctions, dealerships, insurance give Buffett insight into cycles. Recent pullbacks signal caution on downturns, yet he sees resolved shortages as transient in a reshoring story. Trump's tariffs intensify supply fractures. Targeting China, Mexico, and Canada, they aim to reverse a $200 billion annual auto trade deficit. GM's 2025 directive to suppliers: ditch Chinese sourcing by 2027 or lose business. With China controlling 40% of electronics and EV magnets, costs jumped 15 to 20%, halting production in key plants. Incidents like Quebec's aluminum fire idled Ford and Jeep lines as tariffs blocked imports. Semiconductor issues furloughed thousands at Stellantis. Inflation raised materials 12%. Uncertainty delays investments. Output swings flood lots amid wage stagnation and healthy but unhelpful 4.5% unemployment for affordability. Despite chaos, a manufacturing revival emerges. Tariffs lever localization. UAW praises him for ending NAFTA disaster, crediting $50 billion in investment since 2024. President Trump's trade policies represent a seismic shift, building on his first-term efforts but with amplified intensity. Aimed at China, Mexico, and Canada, these measures seek to reclaim a $200 billion annual auto trade deficit through 25% tariffs on imports. The rationale is straightforward. If imbalances persist, the system is flawed and must be fixed, even if it inflicts short-term pain. Invoking national security under Section 232, the administration argues that domestic production capacity is essential to avoid foreign dependencies. The immediate fallout has been severe. General Motors, America's largest automaker, mandated in spring 2025 that thousands of suppliers sever Chinese ties by 2027 or face contract termination. This isn't trivial. China supplies 40% of global auto electronics and rare earth magnets for EVs. Alternatives are limited and expensive, driving component costs up 15 to 20%. GM's response, investing in Nevada lithium mines and North American chip fabs, is strategic long-term but costly now, leading to weeks-long production stops in Michigan and Ohio. Broader incidents compound this. A September 2025 aluminum smelter fire in Quebec disrupted supplies. Tariffs made imports uneconomical, idling Ford's F-150 lines in Dearborn and Jeep assembly in Toledo. Lingering semiconductor shortages from Asian tensions bottlenecked airbags and infotainment, furloughing 1,200 at Stellantis in Windsor. Inflation hiked raw materials 12% for the Q4 2025 Automotive Logistics Report. Tariff flux detains supplier investments, slowing capacity builds. This erratic production floods dealer lots while demand lags. With 4.5% unemployment but stagnant wages, families can't afford $48,000 vehicles plus 7.5% financing. It's a profound mismatch, unsustainable without adjustments. Yet, beneath the turmoil, a transformative reshuffling is underway. Tariffs act as catalysts for domestic manufacturing's return. The UAW hailed the March 2025 announcement as ending the NAFTA free trade disaster, crediting policies with $50 billion in investment since 2024. Fame's congressional testimony, tariffs are messy medicine, but they are curing the offshoring cancer. This messy medicine yields results. Big Three, GM, Ford, Stellantis, pledge 100,000 new jobs by 2028. Ford's $11 billion Ohio battery plant, operational mid-2025, employs 2,500 union workers. GM's Tennessee EV hub adds 3,000, converting shuttered sites in Rust Belt towns like Lordstown, Ohio, idled in 2019, now buzzing with Ultium battery production. Foreign automakers join, dodging tariffs via U.S. builds. Toyota, hit by Mexico tariffs, announced $4 billion expansions in Indiana, Kentucky, shifting 200,000 Camry IEV4 units stateside. Honda's $1.5 billion Ohio investment localizes Civic hybrids to 90% domestic content. Volkswagen scales Chattanooga's Atlas SUV output 30%. Hyundai's $7.6 billion Georgia Metaplan produces 300,000 Ioniq EVs yearly, employing 8,500, many unionized. The Center for Automotive Research estimates tariffs could cost importers $18 billion by 2026, spurring a nearshoring boom. Nissan or Mazda rear out from Mexico. BMW, Mercedes bolster South Carolina, Alabama plants, adding 1,000 jobs for X5 production. Net 42,000 new auto jobs in southern Midwest since January 2025, outpacing disruption losses. Critics warn of $2,000 to $3,000 price hikes per vehicle, Edmunds analysis, and retaliatory tariffs, like China's 40% on U.S. soybeans, hurting farmers and dairy. Unions remain optimistic, gaining leverage. Recent contracts grant UAW organizing rights at foreign plants, a first after decades of resistance. Buffett views this cautiously. His value investing, buy low, hold through volatility, aligns with long-term sovereignty bets, but he frets short-term pain's magnitude. As factories sprout in Appalachia, our Midwest, the heartland pulses anew, gritty and thorn-filled, but reviving nonetheless. Buffett's car anecdote underscores frugality amid economic pressures. His warnings on cars piling up metaphorize market disconnects. The reset's outcome? A stronger, self-reliant economy, if patience prevails. Electric vehicles were supposed to revolutionize the auto industry, but instead, they're intensifying the inventory crisis. Promoted as the inevitable future, gas engines obsolete, transition assured, EVs have benefited from massive subsidies under the Inflation Reduction Act. This influx spurred production of models like Ford's F-150 Lightning and Chevrolet's Silvia Do EV, with tax credits making them appealing for manufacturers and buyers alike. Theoretically, it was a win-win, boosting green tech while stimulating the economy. In practice, however, EVs are compounding the pileup. Consumer adoption has stalled due to persistent concerns over charging infrastructure, range anxiety, and real-world limitations. Worries about long trips, towing, or cold weather performance, where range can plummet, have led to hesitation. Rather than absorbing inventory, this has triggered aggressive discounting to move stock. Tesla, the EV trailblazer, exemplifies a shift. A 5% decline in U.S. deliveries for Q3 2025 shattered its growth narrative, prompting substantial price reductions. These cuts rippled across the industry, forcing competitors like Ford, GM, Mercedes, and BMW to slash EV prices, eroding margins sector-wide. What began as a subsidy fuel boom has devolved into a race to the bottom, with profitability suffering amid overproduction. Buffett's long-standing cautions align perfectly here. His repeatedly highlighted depreciation's pitfalls, a $40,000 vehicle depreciating to $25,000 the moment it's driven off the lot represents an instant 37.5% loss. In his view, such purchases are among the worst investments imaginable. He advocates buying only what one can afford in cash, a principle that seems extreme given most can't outright purchase a $50,000 car but exposes the dangers of extended financing. In an era of 7 to 8 year loans, consumers often commit to payments that strain budgets, masking underlying unaffordability on rapidly depreciating assets. This mindset resonates amid broader economic strains. With vehicle prices at record highs and interest rates elevated, EVs added complexities, higher upfront costs despite subsidies, infrastructure needs, deter buyers. Manufacturers, having ramped up EV output to meet policy incentives and market hype, now face the same glut as traditional vehicles. Buffett's insights stem from experience. Berkshire Hathaway's investments in auto-related businesses, from auctioneer Copart to dealer networks and insurers, provide him a front-row seat to industry cycles. His recent divestments from some dealer operations signal apprehension about impending downturns, reflecting wariness of over-reliance on trends like EVs without proven demand. Yet, Buffett isn't purely pessimistic. He acknowledges that resolved bottlenecks, semiconductor shortages largely fixed, supply chains repaired, position this as a transitional phase. The oversupply is a hiccup in a larger narrative of reinvention, particularly as trade policies drive reshoring. Trump's tariffs intersect with EVs critically, given their reliance on rare earths and batteries often sourced from China. Policies targeting these imports force diversification, spiking costs short-term but potentially securing domestic EV supply chains long-term. Investments in U.S. lithium mines and fabs aim to reduce vulnerabilities, aligning with national security goals. Unions and manufacturers see EVs as part of the revival. GM's Tennessee hub and Ford's Ohio plant focus on EV components, creating union jobs in revitalized facilities. Foreign firms like Hyundai's Georgia plant emphasize EV production to qualify for tariff exemptions. Critics argue subsidies distort markets, flooding lots with vehicles consumers aren't ready for. Combined with tariffs, this could prolong the glut. Buffett's philosophy, value over flash, critiques the EV hype. As piles grow, it underscores the need for balanced demand, not policy-driven overproduction. Amid the auto industry's short-term chaos, a profound manufacturing revival is taking root, driven by Trump's tariffs as levers for localization. While disruptions dominate headlines, production halts, cost spikes, inventory gluts, the long-term trajectory points to renewed domestic strength. The UAW's endorsement encapsulates this. Despite pains, policies are curing the offshoring cancer, spurring $50 billion in investment since 2024. Big Three commitments underscore the shift. Pledging 100,000 jobs by 2028, Ford's $11 billion Ohio battery plant employs 2,500 union workers. GM's Tennessee EV hub adds 3,000. These repurpose idle sites, revitalizing Rust Belt communities like Lordstown, Ohio, where shuttered plant now produces Ultium batteries. Foreign automakers, once offshoring enthusiasts, are relocating to evade tariffs. Toyota's $4 billion Indiana-Kentucky expansion shift 200,000 Camry IEV4 units U.S. side. Honda's $1.5 billion Ohio investment achieves 90% domestic Civic hybrid content. Volkswagen boosts Chattanooga's Atlas output 30%. Hyundai's $7.6 billion Georgia plant builds 300,000 Ioniq EVs, employing 8,500 unionized workers. Analysts project $18 billion in importer costs by 2026, fueling nearshoring. Nissan or Mazda rear out from Mexico. BMW, Mercedes expand South Carolina, Alabama, adding 1,000 X5 jobs. Net gains, 42,000 positions in South and Midwest since 2025, surpassing losses. Critics highlight drawbacks. $2,000 to $3,000 price hikes per vehicle, retaliatory tariffs hurting agriculture. Yet unions prioritize job repatriation, gaining organizing rights at foreign plants. A historic win. Buffett looms as a cautious observer. His value investing, by undervalued, endure volatility, compound gains, mirrors a policy bet, short-term sacrifice for long-term sovereignty. He worries about transition pains but might appreciate the logic of rebuilding resilience. As factories rise in Appalachia or Midwest, the heartland revives, gritty yet promising. Unsold cars mark the messy middle. Beyond lies potential sustainability for workers and communities. Patience, per Buffett, is key. Whether the gamble pays off remains time's test.